You're listening to How India's Economy Works, hosted by journalist and author Puja Mehra.
Hello, I'm Puja Mehra. Few people realize that the largest segment of India's economy isn't the corporate sector or even government, which includes PSUs, etc. It's the household sector. You and me. Trouble is, it's very difficult to understand this sector, and it can even become a bit of a guessing game because there's very little direct data available on the household sector. Economists are generally puzzled therefore by Indian households, but they're even more intrigued right now for the reason that for the first time in history, the household sector's income growth has been slowing down, while consumption has not. This isn't necessarily a bad thing, but in India's case, it could be a sign of distress. Some economists are saying there's nothing to worry. My guest today is Nikhil Gupta, who is reasonably worried. Nikhil is the chief economist in the brokerage house Motilal Oswal. I first found out about Nikhil from Martin Wolf's FT column that was all praise for Nikhil's book, The 8% Solution, A Strategy for India's Growth. This book explains how the household sector and the other sectors of the economy interact and why the outcomes of those interactions turn out to be different than what linear logic would suggest. Readers unfamiliar with economics will challenge every single notion they've held about the economy after reading this book. Hi, Nikhil. Thank you for coming to the show.
Hi, Pooja. Thank you very much for having me on the show. How are you?
I'm good, but please tell me for this episode, how is the household sector, India's household sector? Please also tell my listeners that how when we look at the Indian economy, essentially when the GDP is estimated, the authorities that do the estimation, they estimate separately the GDP of the household sector, the corporate sector, the government sector, and then they aggregate it together. And that's how we get the GDP figure, which also means that we get a lot of information about the household sector, the corporate sector, the government sector. And economists like you analyze all of this information and tell us basically what's going on in the household sector. I also want to tell my listeners that we are focusing more on the household sector because it's more than 50% of the GDP. More than 50% of the GDP comes out of the household sector. So it's very important to understand what is going on in this sector right now. Nikhil.
Sure. Thank you, Pooja. Okay, just a correction. Household sector, actually, you're right. Household sector accounts for more than 50%. It actually accounts for somewhere close to 70% of GDP in India. Household sector consumes as well as it invests. Consumption itself is close to 60% of GDP. And investments, almost one third of investments are done by the household sector. So roughly around 70%. That's how important the household sector is. Now, before I go on to talk about the financial position of the household sector in recent times, you mentioned that GDP is actually calculated or estimated after looking at all the three sectors. It's actually the reverse. GDP is estimated first, then we get hardcore data for the corporate sector and the government sector, and household sector is actually estimated as a residue. Just a technical point, not sure if that is important for this conversation. Coming back to the financial position of the household sector. Okay, so to start with, uh, when I talk about the finances of household sector in India, there are primarily, in total, only five variables that I think we have data on or we must be looking at. The most important by far is household income, which is also called personal disposable income. Income is the basis of all spending, saving, everything that is done by the household sector, just like you or me or any company or any government. Income is the basis of the ability of me or ability of you to be able to spend. Income is first, then comes consumption, because a majority of my income is actually spent on consumption items, which includes everything ranging from food items to clothing to the rents that we pay on our living, to the transport sector, everything. Most of the things that we spend on is consumption. Third segment is investments. Now, where do households invest? Household invests primarily in the residential real estate. So when you and I buy a house or we renovate our house, all that is a part of residential real estate investment, which is a part of household investments. Fourth, there is household savings. Now, household savings in India are estimated in two parts. One is the investments, which I just talked about. That is actually a part of household savings in India. But purely, when we talk about household savings, purely is a financial savings. And household financial savings are actually net financial savings, which means gross savings that I put in all the financial assets, subtract all the liabilities that I have taken in that particular year. So it's gross financial savings minus borrowings, which gives me household net financial savings, which is the pure savings of household sector. And fifth, last, is the borrowings or household debt that we keep hearing about a lot in these days. Uh, Outstanding borrowing or annual borrowing. So these are the five indicators that we must be looking at in conjunction. If I'm just talking about consumption or if I'm just talking about debt, that I don't think gives a comprehensive picture, because eventually everything has to move in line with each other.
Before you would tell us the macro picture, can you give us the example of one household, like my household or your household, and just explain what you have said? So that'll be easier for listeners to understand, how it is.
Sure. So, okay. So, let me give you my example. So, I'm a part of the household sector. I'm an individual. I get gross income. I pay taxes to the government, and then I get take home, which is total income after taxes. That is what is available for the household sector to spend or save. That is what is available for me to spend, save, or do whatever I want to do after paying taxes. Of that disposable income, I can either spend on consumption, I can buy a car, I can spend on eating outside, I can take spend it on travel too. That all is a part of my consumption. Or I can buy a house, or I can renovate my house, which will be a part of household investments, which is also called physical savings, part of the household savings. So consumption and investment both are actually spending of mine, which is, but the classification is a little different in national accounts. One is called consumption spending, and the other is called physical savings. It's a little confusing, but it is actually investment spending or spending that I have done on the residential. Then my income, whatever I've spent on consumption and investments, whatever is the excess of my income over consumption and investments is estimated as household financial savings, the pure financial savings that I talked about. Now, please note, in India, we do not estimate savings directly as the difference between income and consumption and investments. It is done separately. So we get separate estimates for disposable income, we get separate estimates for physical savings, we get separate estimates for consumption. They all are linked, but there have been some trials which have been done, but the authorities were not very satisfactory with the results. So they dropped this idea of directly estimating savings. We do it separately, but effectively, since savings is income minus consumption and investments, they match each other. Effectively, they match each other. And lastly, if I take any borrowings from the loan, from the bank or from an NBFC, either to buy a house or to buy a car or to finance my studies or for whatever purposes, in many areas you take loans for even wedding purposes also, or for any medical emergency, all that will be a part of my debt. So please note, when we talk about income, income is always annual in nature. There is no concept of outstanding income. So always annual, the flow variable. Same is the case with consumption, same is the case with investments, and same is the case with savings. It is only debt which can be a flow variable as well, and which also can be an outstanding debt, which means what is the total debt at the end of the year, starting from whenever you have taken the debt.
Now, we hear so much about one set of people saying that households have been borrowing too much, they are not saving, they are borrowing even to consume, they're not earning, so their households are under stress. We hear another set of economists say that true households are borrowing, but they're borrowing because they're investing, so it's not something to feel concerned about. How are you looking at all the information and data that's available, and what is, as of now, the financial condition of Indian households?
Right. Okay. So to start with, I'll spend some time on non-borrowing part of the household situation, and then I'll discuss in detail the borrowings part, because eventually it matters what is happening to all of these components. Okay. So first of all, according to me, the biggest concern in India, or the biggest concern for the household sector, is the fact that household income growth has weakened in recent years. And this is not something which has happened only after COVID. This was the case even prior to COVID. Now, how do I know income growth is weak or it is stronger? I compare it vis-a-vis consumption. Eventually, as I said at the beginning, you will be able to spend out of your income. So your spending growth depends on your income growth. What has happened in the past decade? So even if you look at a few years prior to COVID or after COVID, what has happened is consumption growth has outpaced income growth, which means if my income is growing from 100 to 110 in time 0 and time 1, my consumption is actually growing from, let's say, 70 in time 1 to 90 in time 2. So income growth is 10%, but my consumption growth is 30% in this case. The effect of this is that your total savings are going down. So earlier I was saving 30% of my income. Now I'm saving only 20% of my income. So this is one of the reasons why savings are going down in India, because the consumption growth has outpaced income. The only other way, so one way I can grow my consumption faster than income is by eating into my savings, which I have been doing. The only other way I can grow my consumption faster than my income is by taking more leverage. That is also something we have done. Please understand that India has always been a very conservative society in terms of spending. We have not been a large borrower, and we have been a large saving country. Households in particular have been very large savers. Our household savings have been close to 25% of GDP 2 decades ago, and it has been 20 to 25% for most of the last 20, 25 years, which is one of the highest in the world, probably only after China, or I think it is comparable to China. Uh, but what has happened in the past decade or so is that my consumption growth has maintained at 7% roughly. Real consumption growth or nominal consumption growth has maintained at roughly around 12 to 13%. But my income growth has been weaker, close to 5.5 to 6% in real term and close to 10 to 11% in nominal term. This has happened because A, I have been eating into my savings, and B, I have taken on more leverage. Now, whether this is concerning or not, I'm a part of the stock market industry. So I look at it this way. If there is one company which is spending a lot, which is what households are doing, but the revenue of the company are falling. So revenue is the income, spending is equivalent to consumption. So if there is a company whose spending growth is higher than their income growth, which means their profits are falling, which is equivalent to household savings, and the company is taking on more leverage. So if I tell you there is a company whose income growth or revenue growth is weaker than its spending growth, its profits are falling and leverage is going up, how confident would you be to invest your money into that company? If you're confident, then you should not be worried about the household. I am not very confident about such company, and I am not even confident that this company will be able to continue with this kind of position for a long period of time. And that is where my concern comes in. That is why I believe that the financial position of household sector has weakened on a broad basis.
But a lot of people will come back and say to you that does it not depend on what it is that households or this company, that example you're giving, what is the leverage for? What is it that they are consuming? What is it that they are investing? Does that matter at all for this analysis?
Yes, that does matter. So one of the counters, as you rightly pointed out, has been that even if people are consumers are borrowing, they're borrowing primarily for the housing sector, which is secured loans. And of course, we know property market has a lot of forward backward linkages, so it is actually good for the economic growth. If you look at data, so the way I look at data, household debt has four parts. There is agricultural debt, which is a part of household debt. There is business debt. So households, when we talk about households, households not only include individuals like you and me, but it also includes all the proprietorships, partnerships, all the mom and pop shops that we see around the country in all neighborhoods. All the unincorporated enterprises are also a part of households. So there are consumers and there are producers within the households, right? So there is agricultural debt, part one. Part two is business debt, the small businesses within the household sector. That is also a part of household debt. Then there is mortgage debt, and then there is non-mortgage personal loans. Right? These are the four components. So the argument that is made is that it's the mortgage loans that is driving, which is relatively better and it's secure. If you look at data, it is very clear that the part which has grown at the fastest pace is not the mortgage loans, it is the non-mortgage personal loans. What are non-mortgage personal loans? It includes all loans taken by consumers for all purposes other than housing. So it includes education loan, vehicle loans, credit card loans, wedding loans, medical emergency loans, you name it. Everything else which is not taken by a consumer, by an individual, it's a personal loan. So it has to be taken by an individual. Every loan which is not for housing is a part of this non-mortgage personal loans. So just to give you some idea, in FY18 or FY19, the share of non-mortgage personal loans in total household debt was roughly around 26-27%. So if total debt was 30%, hypothetically speaking, this non-mortgage personal loans was roughly around a quarter, slightly more than quarter. In FY24, my estimate suggests that the share has now increased to 32% of total household debt. So this portion, non-mortgage personal loans, have grown at more than 20% CAGR for the past many quarters. Housing loans, on the other hand, have grown at close to 15% CAGR, which means the share of housing loans have been broadly stable at 30% of household debt. The share of agricultural loans has gone down, and the share of businesses has slightly been low. But all said and done, the portion which has grown the maximum, the highest, is the non-mortgage personal loans, which is purely consumption-driven loan, or the loans that are taken for consumption purposes, not for uh, housing or for non-consumer purposes.
And still, when we look at the entire economy GDP estimates, we find that consumption growth is not keeping pace with GDP growth. How do we reconcile this?
Yes, so this is one puzzle. I think we still do not have too clear an answer because not much details are available as far as consumption is concerned. We do not have any clue if we look at the consumer from pyramid perspective by income, or if we divide them basis on their wealth. We have no clue which segment is driving it. But just to throw some possibilities, this combination of rising consumption loans but weak consumption growth, it could be because a part of consumption is not driven by loans. So there will be consumption which will be driven by loans, and there will be consumption which are not driven by loans. It is possible that that portion of consumption which is not debt led is actually driving the slowdown. Now, one could argue who are the primary consumers who do not have debt and whose consumption is weakened, if it is at bottom of the pyramid or it is somewhere in the middle of the pyramid. We have no clue about that. But basis on different hypotheses, this combination itself is very puzzling, and this is one of the reasons why I don't think. Okay, so I'm not saying that household financial position is on the brink. It is not like something is going to break. We have no clue if it is going to break in a year or 5 years or 10 years or 2 years, because this is unprecedented for India's economy. What I understand is that things are not moving in the right direction for the household sector. We have become too ambitious in terms of maintaining our consumption growth, but my income growth is not that supportive. And I'm able to be so much ambitious because not only I had my past savings to live on in the present or probably for some time in the future as well, but I also have got new amazing access to this all the borrowings that I can get. I can get it over my phone. I don't even need to go to any bank branch or something. I can get it on any many apps that are now available. So the access has improved massively. If I look at my neighbors, the social circle has become something like I can get anything which was produced in America or which one of my friends in America has. I want it tomorrow, I will get it within a week or less than a week. So that kind of ambition has probably led to this maintenance of consumption growth for a long time. FY24 was the first year when we saw weak consumption growth. Probably it will maintain, by which I mean that consumption growth will continue to remain lower than income growth in the coming years, which is actually what is necessary to push savings back higher and to increase the serviceability of the debt that household sector has taken. This is just a hope. I don't know if that will happen, but if that happens, then may have some adverse impact on the overall GDP growth as well. Because as we discussed earlier, households account for 70% of GDP. If their spending growth weakens, it will have most likely it will have most some adverse impact on GDP as well.
Right. I wanted also now for you to explain what is the role of the household in the overall economy? How does the household sector interact with other parts of the economy? Why is it, although it is the biggest part of the economy, but why is it that we need to focus on the financial strength of the economy?
So there are three sectors in any economy, three domestic sectors: household, corporate, and government. Households is by far the largest sector, but all the three sectors are extremely connected with each other. How? To just give you a few examples, we can say household sector is the most important, but that would not be true because household income, which I started this conversation with, household income is actually derived from the corporate sector. It's the companies which employ people and give them income in wages. Where do companies get money from? They get money from my consumption spending, which an individual or someone else has spent. So it's a circle. As we all know, economics is all about interconnected. And it is never, should never be seen in isolation. Every policy will impact the targeted sector, but it will also impact all the untargeted sectors as well. With my income, I pay taxes. That is the revenue or the income for the government, from which the government decides whether they want to build a road, or they want to increase salaries of government employees, or they want to give it to the rural sector in terms of fertilizer subsidy, food subsidy, or some other social programs. So everything is connected. If household spending growth slows down, the revenue growth of the corporate sector will slow down, which may push them to reduce the growth of income of their employees, which will create lower income growth for the household sector, which will lead to slowdown in tax growth for the government sector, which will make them slow down their spending on whatever purposes they have been spending, or they will have to borrow more to maintain their spending. Everything is connected. It's not like household sector is at the center. It is at the center, probably put by corporate and the government sector, but all are important, and a problem in any of these sectors can affect everything else as well.
So you're saying that what the household sector consumes affects the income of the corporate sector. What the household sector earns probably affects the revenues of the government sector. All of it is interconnected, and there's spillovers from one sector to the other sector, and therefore it sounds very complicated. It's probably even more complicated than what it sounds like. So we get the sense from what you're saying that you have some concern about the household sector, and you've explained why that is so. If there's anything you want to discuss in terms of the policy framework which may be leading to this, or policies that may have to be used to address the situation, or we can just let this play out. There is no need for government intervention.
So, Pooja, as far as borrowings are concerned, the RBI can actually control the supply of funds. They have very limited control over the demand of loans that is being done by the consumers or the household sector. The only blunt tool they have to probably affect the demand is the interest rates. If you want to curtail demand, you can hike interest rates. But I don't feel there is any need for the RBI to hike interest rates just because consumer loans are high. Interest rates are a very blunt tool, and it affects a whole set of participants in an economy. As far as supply is concerned, again, in the last 6 to 9 months, the government has taken a few steps. The RBI has taken a few steps to check on the rapid growth that we have seen in a few NBFCs or a few app-based loans that have happened, which is absolutely correct. It is not easy. We must understand this because at least I can tell you, since a lot of data is not in public domain, so it becomes very difficult for us to understand where is the problem, which sector is facing the problem. Uh, all my analysis is based on only the macro data, which comes with a lag. The RBI and the government would have definitely much better data. If we talk about the other problem, which is the fall in savings, I think that is where the policymakers have more options. One of the options is I've always recommended that the government, through their policies or the RBI, should not do anything which encourages consumption further. So, yes, consumption growth has weakened in FY24, but we must understand that consumption was the primary driver of the growth that we saw prior to COVID. And the fall in savings has been there for almost 10 to 12 years. FY24, according to me, was the first year when household savings picked up after many years, many normal years, except FY21. But it's still much lower than what it was a decade ago. So we have a long way to go in terms of pushing household savings higher, wherein a lot of policies can come in handy. Now we are seeing that the government has been trying to simplify or rationalize the personal income taxation entire regime, which has been there for the past decade. They have been trying. Late Mr. Arun Jaitley started it, and Ms. Nirmala Sitharaman continues with it. That is all good, but the side effect of that is that whatever incentives I had to save in a few financial assets because I was getting tax breaks or other incentives, they would not be available in the new tax regime. Now, so if there was incremental savings which I was doing in order to uh, earn those incentives to get that those tax breaks, if I opt to the new tax regime, I will not have that incentive. So it's an incremental, but incrementally negative for savings. And I think we are at a situation where even incrementally, we should not be doing anything which encourages consumption or discourages savings. That is just one of the examples. Uh, uh, so this is how I think. Again, if there is a side effect, if you try to slow down consumption growth, consumption is 60% of GDP, so you need to be aware of the possible implication for GDP growth as well. So it's, as you rightly pointed out, complicated. I find it interesting, but yes, it is very complicated as well.
And Nikhil, let me now bring you to the macro picture. So, what you're telling us, can we in any way look at this as a comment on the quality of GDP growth, how the economy is behaving? That must be a determinant of how households are behaving. If you do not, for the lack of information or data, have this view on the current set of numbers, by looking at historical numbers over the past many, many decades, can you then sort of analyze and assess if there is some link between how the household behaves and how the sort of the growth story tends to be?
So as far as the macro picture, GDP data is concerned, the unfortunate part is when we look at the breakup of GDP by consumption investments, FY24 was a superb year. It beat all the forecasts that we have had during the year. Everyone has revised up their forecast, but still the final number was much better than all the forecasts. The problem is that out of 8.2% GDP growth that was posted for FY24, as much as 4.2 percentage points, which means roughly half of that growth, is attributed to discrepancies. Now, it does not mean that GDP growth is overestimated or GDP growth is not rightly estimated. GDP growth in India is actually estimated separately through GVA growth, which is a much more robust methodology. What it tells me is that the statistical authorities have not been able to distribute GDP into consumption and investments properly. As the data is revised, it is possible that consumption growth may be revised up so that discrepancies go down, or probably investments will be revised up, which means what we are talking today that consumption growth is weak. How does it sit with strong consumer loans? It may actually be the reverse. After a year, we come to that consumption growth was not actually 8.5% in nominal terms. It turns out to be 10 or 10.5%, which would be roughly similar to what it was in FY23. Right. So probably this entire question may be answered by their revisions. But just coming back to your question on the macro picture and how the things have been historically, if there is any precedent, I do not have any precedent because in India, this is the first time when consumer debt is growing so rapidly. The only year when we saw such rapid buildup of consumer loans earlier was in FY07. The only year, just because before the great financial crisis, we saw huge buildup of household borrowings in FY07. And as the great financial crisis unfolded, India's story or household debt also started unraveling with that. And we saw it coming off in FY08 and in the subsequent years. However, this is the first time when we have seen for 2, 3 consecutive years when household or consumer loans have been growing at such a rapid pace. So unfortunately, there is no. In fact, if you look at household savings, we have data since independence for savings, consumption, and income. We have never seen a decade long fall in household savings in India. I mean, we must understand that India is one of the youngest nations. We are still less than 30-year median age country, which means we are still a working age population is the highest share of my, which means my savings should be going up because I would be consuming my savings when I grow older, which is what happens in all the older countries like Japan, US, China, etc. So I must be building up my savings for the rainy days. We do not have any unemployment benefits on any given rainy day. We are dependent on our bank deposits or cash or other savings that we have. So, considering the fact that we are such a young nation, I find it really surprising that my savings have been falling for such a long time. And I still believe that not enough attention is being put by the policymakers on these facts, especially the financial position of the household sector. We are happy that GDP growth is good and GDP growth is better than expected, but can it sustain if household position continues to worsen? I definitely doubt it. And that is where my concern.
And what about income growth? How has income growth been over the earlier decades? And have we seen this kind of slow growth in income growth of the household sector?
No. So we have again this data since independence, and if we look at decadal data since independence, 1950s, 60s, 70s, 80s. So we have 7 decades and 4 years data, 74 years post independence. For the first time, so if you look at 1980s, 90s, 2000, 2010s, 2010s, that is prior to COVID, personal disposable income growth was in very low double digit, which is close to 11.5% in nominal terms, which was much lower than what it was in 2000s decade, which was much lower than what it was in 1990s. In the last 4 years, it has fallen into high single digit, roughly around 9.5% or so. I'm talking about nominal numbers. Right. Now, last 4 years, one can see was affected by FY21, wherein we saw a decline in GDP and income growth was nominal, was marginal in nominal terms. But we must remember that I'm talking about the last 4 years. Because of FY21, we saw huge growth in FY22 and FY23 as well. Right. Still, even if we ignore the last 4 years, all I'm trying to say is that income growth on an average over the decades has weakened. Now, this again is not a concern, Pooja. Again, as I said, household income growth weakening is not a concern because if household income growth is weakening, it is very likely that someone else, probably the corporate sector, is making more money, which we know is the fact. If we look at a lot of countries, emerging markets, successful countries, for example, China, Korea, Taiwan, Brazil, Germany, etc., this is something very natural. All of these countries have seen lower share of household income vis-a-vis GDP, which means income growth is weaker than GDP growth. But what has happened when income transfers from household to corporate sector? The corporate sector spends. Where does corporate sector spend? Corporate spending is only investments. They do not consume anything by definition. So corporate investments pick up, household consumption comes down. This is what we are seeing in most of the economies, as we call them, investment-led or export-led countries. That is the problem. That is the gap which is there in India. My household income growth is weakening, but still the primary driver of my growth is not corporate investments, but household consumption or household investments. But it is still the household sector. So the sector whose income is growing at a faster pace, which is the corporate sector, they are not spending at the same pace. And for the household sector whose income growth is weakening, we want to maintain our spending growth or probably better it over the coming years. This disconnect between income and spending growth is simply unsustainable. I would want my corporate sector to spend in line with their income growth, which means total investments will pick up, corporate investments will pick up, which has been the narrative for the last 2, 3 years. Hasn't happened so far. hopefully it will happen this year or next year.
So you're saying corporates are sitting on cash surpluses, is it? Is that what you're saying?
So they have cash as well. But again, if I look at their investment growth vis-a-vis their savings growth or income growth, so corporate sector, let's say in FY8, FY7, which was the best period, but not the right comparable period. But just to give you an idea, corporate investments in FY6, 7, 8 was more than 20% of GDP. And their savings were 13, 14% of GDP. So on a net basis, they were actually borrowing as much as 6 to 7% of GDP worth of funds, right? This was their net balance. Now, if you talk about FY21, 22, 23, 24, their net balance is roughly around zero, which means their savings and investments are roughly equal. Now, the question is, have their savings gone up or have their investments gone down? Interestingly, corporate savings at FY24 data is not yet out. If you look till FY23 or my estimates based on various data, corporate savings is roughly around 14% of GDP, which was the peak that we saw in FY7. But my investments, which were at 20, 21%, they are now down to 30, 40%. So that is why the corporate sector in during the best time, and I define the best time as the most confident, when everyone is super confident that growth is going to sustain. That is the time when animal spirits come back, as we call it, and when everyone is ready to invest, to commit to the future. I'm going to spend today because I know tomorrow is better. So during those times, the corporate sector should be a net borrower. Their spending or investment should be higher than their savings. That is not the case today. That is not the case till FY24. And again, this is not something which started happening post COVID. If you look at from FY11, 12 till FY19, the net borrowings of the corporate sector were narrowing year after year. And they have just disappeared entirely. It's at roughly around 0% of GDP in the last 3-4 years. That is where my concern is. I'm not asking them or I'm not expecting them to go back to 6-7% kind of borrowings again. But probably 3 to 4% worth of borrowings are necessary for them to keep India's GDP growth above 7%.
So you explained the corporate side, and on the household side, when you say that it's natural for household incomes to growth to keep reducing, but the countries that example you're giving, they are not large labor surplus countries. So am I oversimplifying, or is it probably linked to the unemployment problem, and that because labor does not have bargaining power, so their incomes are not growing? Is that what is happening?
Oh, so let's talk about China, which is also a labor surplus country. The story was similar there. Their household income was much weaker than their GDP growth. Their consumption growth was much weaker than what it has been in India. But they transferred the resources from the household to the corporate sector. So the government took a lot of policy which benefited the producers vis-a-vis the consumers. Now the question is, who will I produce for if my consumption growth is weakening? And the answer is you produce for the rest of the world. So this is all a kind of plan which China is not the first country which has used this plan. Japan started this, and after that, a whole host of countries have been following this economic growth model. You suppress the domestic household sector, you support the domestic producers to cater to the rest of the world. Because even for the largest economy in the world, which is the US, rest of the world is much bigger than the domestic. So if you are able to crack the rest of the world,
For my listeners who don't know, rest of the world means exports.
yes, I'm sorry. Yes, exports. So that is how it's investment-led and export-led economic growth models, which most of these countries have followed. So this is very natural, and it has nothing to do with labor surplus or labor deficit countries. China has done it. Similarly, countries like Taiwan has also done it. Korea has also done it, which was not a labor surplus country. Yes, but what matters is the quality of labor. Again, in China, the quality of labor was much better, or in any other country, Korea, Taiwan, Singapore, the quality of labor has been much, much better. By the quality of labor, by which I mean education standards of the general workforce. That has been much better so that they can do much higher skilled works. They can produce things which can compete with the best of the best in the entire world. If you are talking about German products, American products, British products, when you are in the export market, you have to compete with them. And it's not about the quantity then. What matters is the quality. So that is where you need to pick up a fight. But that is what all these countries have done. So it is not true that labor surplus countries cannot follow that. At the same time, we must understand, which is a little complicated part, there are stages of development. So, for example, what I'm trying to say is 1980s, 1990s, especially in 2000s decade, the globalization was increasing year after year, decade after decade. Things have reversed post Great Financial Crisis. If not outright deglobalization, then definitely globalization growth has slowed materially, right? And we know protectionist policies have increased across the world. If that is the case, is it possible for any economy, let alone India, which is fifth largest economy in the world, is it possible for any economy to follow the export-led model or to push the producers to cater to the export market vis-a-vis the domestic market? It has become more challenging, is what I would want to say.
Right. Although many economists say that given India's share in world exports is so low, we can simply, for some more time, be not giving away our market share to other economies like Vietnam and Bangladesh and increase exports. But that's a different topic, and that probably we can do another different episode. But my last question for today is so what's the overall story we are now getting from comparing the behaviors of the household sector and the corporate sector? Is it that the corporate sector is being cautious and the household sector is slightly more hopeful because they're taking on loans to consume and corporate sector is just not investing? Is that what's happening?
I would agree with that. Yes. The question is, why is that happening? I can understand household or consumers being more confident. I mean, they should be confident. Why should they be? But there is a lot of debate on why is it that the corporate sector is not investing despite having the best profit in 15 years, great market share, rising cash flow position. What is it that is stopping? Again, the jury is still out, but one can argue that probably it is their cautiousness that they are not so optimistic about the future. Because eventually producers will produce or they will expand capacity only when they are confident that consumers are going to grow their spending at the same pace, if not more. But if household sector position is weakening, then there is a question mark on their ability to continue to spend, to grow their spending at the same pace. Again, it's a long shot. I have no clue if it is on the minds of the companies when they think about their capacity expansion, but a possible reason. But yes, the concern that I have or the worry that I have in terms of economic growth comes from the corporate sector. Why is it that they're not able to invest, or why is it that they are deciding not to invest as strongly as their books suggest or their financial position suggests?
Right. Thank you. Thank you so much, Nikhil.
Thank you very much, Pooja.
Some economists have suggested there are financial crisis loans, but I haven't seen them provide any evidence. Nikhil's worry is that the trend of rising consumption and leverage of households at a time their income's growth is slowing is not sustainable. How will this play out? Do India's macroeconomic policymakers have the faintest idea about the risk to the economy? We know the answer, I think.
You've been listening to How India's Economy Works, hosted by journalist and author Puja Mehra. Do stay connected with more of our coverage at The Core. You can check out our website or sign up to our newsletter at www.thecore.in. That is www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback, so do write to us at feedback@thecore.in. Thank you for listening.